did everything right. You researched, you read the analyses, you followed the experts' advice. So why is your portfolio still letting you down? Think about it. In 2022, when the S&P 500 dropped 22%, some of the market's safest stocks fell over 40%. Some of those who put money into tech funds saw half their savings disappear. But at the same time, some portfolios were only slightly scratched. Why? I'll give you the answer to that question in this video. And the answer is simpler than you could imagine, but applying it is incredibly precise.
By the time you finish watching this video, here's what you'll have learned. First, what portfolio diversification really means, because most people get it wrong. Second, which asset classes to hold in what proportions under the 2025-2026 market conditions. Third, the most critical trap people fall into when diversifying and how to avoid it. And most importantly, I'll give you a concrete framework you can apply today, not theory, action. Think about this. You research for months. You look at the company's balance sheet, watch the CEO's interviews, read Reddit threads, you do everything. Then you buy. And a year later, your portfolio is either stagnant or in the red. You're not alone in this. According to research by Schwab in 2024, 64% of individual investors underperformed the S&P 500 over a 5-year period. 64% in 5 years. This is not a coincidence. So why does this happen? Because people think they diversified, but they actually didn't. They bought Apple, Google, Microsoft, Nvidia, 4 different stocks, but they all move with the same emotion. When interest rates rise, they all fall. When recession fear kicks in, they all crash. This is where the painful truth comes in. Buying different companies is not the same as taking different risks. And this is not just a problem for individuals. In 2022, Cathie Wood's ARK Innovation ETF lost 73% of its value. Dozens of different companies were inside the fund, but they were all in the growth technology theme. The diversification was visible on paper, but didn't exist in reality. Now, what do you think the real problem is? Losing money? No. The real problem is this. Human psychology breaks at this point. When the portfolio falls, people panic, sell at the wrong time, do even worse, and they enter a spiral.
Diversification means holding assets with low correlation to each other. I know your eyes glazed over at correlation. Let me put it simply. When one asset drops 10%, if the other drops that same 10%, the correlation between them is very high. There's almost no difference between them. But if one asset falls while the other stays stable or even rises, that is real diversification. The losses in your portfolio cancel each other out. What do we see when we look at markets right now? The Fed began cutting rates at the end of 2024 and entered 2025 with a target band of 4.25 to 4.50%. Inflation is not yet fully under control. Stocks, especially big tech, are trading above their historical average valuations. Putting everything in one basket in this environment means serious risk. For a solid portfolio, you should look at these asset classes. First, equities. But which stocks? Spread them geographically, not just the US, emerging markets, Europe, Japan, because as of 2025, the dollar remains strong, but that can change, and when it does, international stocks suddenly become attractive. Second, bonds. Short-term U.S. Treasury bonds are currently offering around 4.5 to 5% yield. This was unimaginable 10 years ago. This is one of the best environments to hold bonds. Third, commodities. Gold, oil, green. Inflationary periods are good for commodities. In 2024, gold's ounce price closed above $2,700. That is not a coincidence. Fourth, real estate investment trusts, or REITs.
Housing prices are at record levels, but mortgage rates are also high. This asymmetric environment creates interesting opportunities for REITs. Fifth, cash and cash equivalents. Yes, cash is an asset class. In 2025, money market funds are offering 4.8 to 5.2% returns. Keeping 5 to 10% of your portfolio here is both an opportunity and insurance. A very common question here is, the more I diversify, the better, right? No. Research shows that the optimal diversification effect plateaus at around 20 to 30 assets. Beyond that, every new asset brings marginal risk reduction approaching zero, but the management cost and complexity keep rising, so more is not always better. One of the most widely used structures by professional portfolio managers is the core satellite model. The core, 60 to 75% of your portfolio. You put low-cost index funds here, an ETF like VTI covering the entire US stock market, an ETF like BND covering the US bond market, international equities like VXUS. This portion is your foundation, passive, low-cost, strong. The satellite portion, 25 to 40% of your portfolio, you put your active ideas here. If you believe in a specific sector, a commodity, a thematic ETF, or individual stocks, you go there from here. The beauty of this structure, your core always protects you. Even if the satellite portion collapses, your portfolio doesn't crash, and that psychological security keeps you from panicking and selling at the worst moment, which is more valuable than anything. Let's say you built a portfolio like the one above. Stocks went up, bonds went down, gold stayed stable. Now 50% of your portfolio is in stocks. You said 35% at the start. This is where most people do nothing. They think stocks are doing well, why touch them? But this thinking slowly moves you away from your original risk profile. You now have a much riskier portfolio than planned, and when a shock comes, you get hit unexpectedly hard. The solution? Rebalancing. Once or twice a year, you bring your portfolio back to its target weights. You sell a bit of the rising asset and buy the lagging one. This sounds easy, but it is extremely difficult psychologically, because to sell the winner and buy the loser, you have to go against the human mind. And this is why many investors fail, not from lack of technical knowledge, but from lack of behavioral discipline.
Have you ever thought about this? Maybe the problem isn't strategy? According to Dalbar Inc.'s annual QAIB report in 2024, the average individual investor earned an annual return of 3.7% over the last 30 years. In the same period, the S&P 500 returned 10.5% annually. This gap cannot be explained by bad strategy alone. The gap comes from here. People sell when the market falls and buy when the market rises, exactly the opposite of what they should do. And this is where diversification's hidden superpower kicks in. A diversified portfolio drops much less during a crisis compared to a single asset class. A portfolio that drops less reduces psychological pressure. When psychological pressure drops, a person manages to stay put. The person who stays put sees the market recover, and compound returns create miracles over time. This is not merely a mathematical benefit of diversification, it is that it functions as a behavioral shield. Let me make it concrete. If your portfolio had only been NASDAQ 100 in 2022, you would have experienced a 33% loss. Staying put under that psychological pressure was nearly impossible. The vast majority sold. But with the diversified portfolio approach I described, a mix of stocks, bonds, gold, and cash, the loss in the same year would have stayed between 7 and 10%. Tough, but survivable, and a person can hold on. In 2023 and 2024, markets saw a strong recovery. Those who held on recovered.
Those who sold in panic did not.
What have we learned so far? First, diversification is not just buying different stocks. It means holding different asset classes with low correlation to each other. Second, under 2025-2026 conditions, holding stocks, bonds, gold, REITs, and cash together creates a sensible structure. The core satellite model makes this practical. Third, and most importantly, the real value of diversification comes not from numbers, but from psychological resilience. Staying put during a crisis is the most profitable move. The first thing you can do after watching this video, today, look at your portfolio. How many different asset classes are there? How do they move in relation to each other? Just asking this question puts you ahead of most investors. If you want to go deeper on these topics, in upcoming videos, we'll cover asset allocation optimization, tax-advantaged accounts, and retirement portfolio structuring. To follow this channel and be immediately notified of new videos, subscribe now and hit the bell icon. Every week, I publish content like this, stripped of unnecessary jargon, directly useful. See you next time.